and welcome to Money Control. There was some good news and some bad news that we got for the stock markets from the budget announced on Saturday. The good news came in the form of tax breaks, which is supposed to bring back to consumer companies some amount of growth, which was seeing a slowdown. The bad news was that capital spending was kept at 11.1 lakh crore, which was the budgeted estimate for FY25 that was not met. Therefore, between last year and next year, there is zero growth in capital expenditure by the government. And the big news that we are seeing this morning is the Trump tariff on China, Mexico and Canada. How will all these factors play out in the stock markets and where do markets go from here? I'm Mahalakshmi and I have with me Neelkanth Mishra, Chief Economist of Axis Bank, who is a very authoritative voice on the economy and the markets. He will join us to decode all of this and more. Thank you so much for your time, Neelkanth.
Thank you, Mahalakshmi. Thank you for having me here.
So first thing is, what did you make of the budget? From a stock market point of view, what do you think changes post-budget?
Not much. So the only surprise for me, frankly, was that the government found the space for the 1 lakh rupees of tax cuts. And again, on that, if you just take a step back, this is the, so given that they met their fiscal deficit guidance of below 4.5% for FY26. The primary deficit at about 0.8% of GDP is now reasonably close to the FY19 levels, the pre-COVID levels. So the COVID bump in deficits that we saw has largely been moved out. The pace of consolidation going forward is also going to be a lot lighter. So the government, to its credit, did give a glide path for debt to GDP. So that's where things are still elevated. The debt to GDP level, because of the action by the government, is still elevated. So they've given a guidance to bring it down. And the range given, they've retained some flexibility, which is very important, given it's a very volatile global environment. That the FY31, which is 5 years from now, the numbers will be 48 to 52% versus 56%. Now, if you take the various ranges in that, you see that in the worst case, the government may not consolidate from here. In the best case, the government may consolidate by 15-20 basis points from here per year. So all in all, the aggressive pace of fiscal consolidation is now behind us. And the debt to GDP fall that happens from here onwards will be driven mostly by the growth in the denominator. So this is all very good. Now, when you compare FY19 to FY26, the two big changes are that your personal income tax to GDP has gone up and the capex to GDP has gone up as well. And now, when you see the conundrum, the problem that the government was facing is that there is no more absorptive capacity for central government capex. So as per the Constitution of India, the central government can only spend on national highways, railways, defense, telecom, major ports, and airports. Now, most of these don't require much capex. So the government and central government can only spend on national highways, railways, and to some extent defense. And I think in some of those it is starting to max out, and there's only a certain pace at which the rest can grow. And therefore, what does the government do? It then decided to, without distorting more of the economy, it has decided to give some of that extra funds back to the taxpayer. And so the group of or the citizens that were funding all of this fiscal consolidation and the rise in capex are now getting some of it paid back. So in aggregate terms, I'm frankly surprised that people think this is a consumption booster because actually the tax to GDP, so even despite this, the personal income tax to GDP will actually go up in FY26. So all that matters from a market perspective is that this about 75 lakh people who are the biggest beneficiaries of this tax cut, where the discretionary demand ends up. And that's where, maybe autos, jewelry, etc., there could be some impact. Beyond that, I think the budget was a non-event. I think the improvement in certainty on the fiscal side should perhaps justify a slightly higher P multiple. But other than that, not much that should be taken away from it.
Right, fair point. So you touched upon consumption, right? And you're absolutely right, because the way the markets reacted on Saturday was also that all the consumption stocks were up. There seems to be this almost consensus in terms of the fact that the entire tax savings will now go to boost consumption. Is that an opinion you subscribe to? Will it go into spurring consumption?
Not really, right? So the fiscal deficit as a percentage of GDP falls. So 4.8 goes to 4.4. So the government is being a drag on growth. The government is reducing aggregate demand. Capex as a percentage of GDP is going to be flat. So forget about what they had said they would do and what they have and so on and so forth. What matters is that so far this year, in the first 9 months, the government was behind the curve in spending. Even on the revised down estimates, the growth in expenditure is going to be up 21% year on year in the last 3 months of the year. In the month of December, government capex was up 95% year on year. And on that base, there is expected to be another 10% growth. So, as a percentage of GDP, central government capex does not change. Aggregate expenditure actually comes down because the growth is less than nominal GDP, and therefore consumption does not get boosted. So I'm quite surprised by how the market seems to be interpreting.
Right. At the individual hands, Neelkanth, I mean, how would you interpret this? Because anybody who is getting this extra money, I'm just saying that this is like a gift voucher that most people got from the finance minister. And at different levels, it will mean different things for people. Will people order more pizzas? Therefore, will Zomato benefit from it? Or people will buy more cars or, houses or whatever it is. How do you see the skew, if at all there is? You don't subscribe clearly to the fact that there will be an overall consumption boost. But if we were to see some pockets pick up at all, where do you see there could be traction from here on?
That's exactly the right way to look at it. That there is a collective, through compliance and improvement in income, boost to taxes. And given that this segment was paying most of the taxes, so some of it is being handed back to them. Now, the good thing is that given the direct taxes statistics that the government provides, and these are people who are paying taxes, so we know their behavior a lot better than of the rest of the economy. 70% of this boost will land up in the hands of about 75 lakh people. So the biggest beneficiaries will be people who reported gross income between 12 to 50 lakh a year. And that number was about 58 lakh people in FY23, the last data we have. Assume that that number will grow, it would have grown. So about 75 lakh people who I think will be beneficiaries of this. Now, given that we're talking about 12 to 50 lakh gross income, we are already talking about, the 90th percentile of the Indian households. And more important than their current consumption is what is their incremental consumption. So how is the consumption of the 95th percentile different from that of the 90th percentile? And there, it is actually a lot less of staples and other such items. It is mostly about high-value discretionary. And I would say, and while it is not considered and counted in household consumption expenditure surveys, but I think the real estate market also gets boosted because this is a segment which does financial savings. So some of it will be saved, but a reasonable part of the rest will actually be levered up. So because it means a car purchase is mostly through EMI, through the auto loans, the ability to service a higher EMI on mortgages goes up. So this, whatever 70,000 crores gets left after the 30% of savings would then get multiplied because this will be used in a levered way. So those are the segments that I would expect to be beneficial of real estate, jewelry, cars, the higher value discretionary items, not so much staples or frankly, even QSR. I mean, I'm not convinced that's a direct beneficial.
Right. So the second question is, the market didn't interpret this correctly, clearly, because even banks, large banks with large consumer portfolios, didn't see any uptick at all.
Okay, so let's see the situation of the market. In fact, one of the reasons I think the industrial stocks are down sharply this year is also the Trump tariffs, because it brings in a significant level of uncertainty on the global economy, the direction of the economy, and therefore capex interventions or capex intentions of various firms. But when it comes to the banks, I think the biggest uncertainty or the biggest question mark is what happens to the monetary policy. See, when you're trying to manage
Right.
the cyclicality in the economy, the macro cyclicality, you can either do it through fiscal routes, which fiscal channels, which, as we just discussed, there's very limited room because the government still had to reduce its fiscal deficit. So then you are left with the monetary channels, and then there is a cost of capital and there is a quantity of capital. The cost of capital is the interest rate. Everyone expects that interest rates will be cut in the upcoming MPC meeting. I personally think that they shouldn't. This is more prescription. But given that the Overton window, which is the realm of policies which are acceptable to the market and the public in general, has shifted. So from 6 months back to now, and 6 months back, no one wanted even a stance change to happen or a CRR cut to happen. But I mean, I was pushing for that. Thankfully, those things have happened. Now, suddenly everyone wants a rate cut. And so if the MPC does cut rates, it will not shock the market. It will not cause a lot of distortion in the financial markets. So frankly, to maintain their credibility on inflation fighting, they shouldn't be cutting at this stage. It's too early. But there is a lot more scope to do stuff on the quantity of money, where I think because of the currency market interventions, almost 5 lakh crores, 5 trillion rupees of durable liquidity has been sucked out. About 1 trillion rupees was kind of, at least announcement happened for reinjection last Monday. It is, I think, required that a lot more happens. Secondly, I think the regulator has been quite stringent in forcing banks to look at many other ratios other than just capital adequacy and liquidity, focusing on things like credit deposit ratios. Maybe if the central bank was to sort of pull back from some of those, there are also channels that it can use like risk weights. So if, for example, the real estate cycle is in a decent place, the risk weights on mortgages can be brought down, and therefore credit growth, which fell from 17 or collapsed from 17% to 11%, I think that has also been a big driver of the slowdown. If we can somehow get it back up to 14, 15%, I think that will work. So when you see the reaction of the market towards banks, it's about, was there something in the budget to boost credit growth? Frankly, that was not the right place to look for it. I think the Monetary Policy Committee's statement, the RBI's actions are going to be far more critical for the banks.
Fair enough. So one of the objectives, I mean, when you just look at it from an outside perspective, the way I interpret this budget is that, government has done its bit with respect to, public expenditure for the last 4 years, nearly 5 years from the pandemic. And private capex was not coming up in a big way. And one reason for that is, of course, the global uncertainty, which is playing out as we speak. And the second thing is people were not really confident of domestic demand. And that's, perhaps what the finance minister was trying to address. But by perking up consumer demand to give the private sector the confidence that they can invest more confidently. Do you think that animal spirit can really come back this year?
Look, it's very important to break down why investment had fallen. So the gross fixed capital formation, which is the investment activity, the measure of investment activity in the economy, had fallen from 34% in 2012 to 27% in 2021. Of that 7% point decline, nearly 5% point was just household investments in real estate. So when people keep obsessing over private sector capex, they're talking about the remaining 3.5%, which is corporate and government investment in machinery. A large part of that was the power sector, and the rest of it was manufacturing that feeds into real estate. So if you sort of drill down, as they call in Hindi, the nichod, the crux of the problem, is that the real estate cycle had seen a downturn and the power generation cycle has seen a downturn. I mean, I'm oversimplifying it, but those were the primary drivers.
Right.
As those cycles have turned, and if we can somehow reverse, these were driving very strong growth. But unfortunately, in the midst of this, we saw this sudden fiscal slowdown because of the elections and in the first 6 months of the year, basically the government spending was way behind the curve. It has now started to pick up, so that is getting reversed. Then at the same time, I think the central bank, in terms of base money injection and then clamping down on the credit deposit ratios, actually inadvertently slowed down aggregate credit growth. See, there were some parts of the credit growth which they wanted to slow down and which was, I think, reasonably justified, which is the unsecured personal loans and the microfinance loans. But those are a small part of the overall loan growth. And system loan growth going from 17 to 11 was where I think the problems arose. So if we can somehow reverse that, then I think the growth expectations and so these are primarily in our control. And this is again another important aspect that there is turbulence globally. This was the title of our FY 2025 outlook. There is turbulence globally. There is likely to be a lot of uncertainty globally. But for private sector capex to revive, we just need to provide enough liquidity in the system because the underlying demand trends are actually quite supportive.
Fair enough. Okay, now going back to the point on capex, how do you interpret this from the stock market point of view, Neelkanth? Because I think road sector, railway sector, I remember you talking about, roadblock in terms of roads, but railways, is this an execution problem, or is there a genuine problem which, prevents more spending on railways? Because that seems like a big growth area which the center can spend on.
Absolutely agree. I think that number can rise meaningfully. See, the railways, if you remember, even 2014, when we had a new railway minister, the plan was to take spending from about $500 billion, which was what in 2014, to maybe 2.5-3 trillion by 2019. But it has, the railways, given that it has its own very hard to crack bureaucracy, it's so far, in fact, you'll be surprised, the railways really struggles to do the tendering and contracting of very large transactions. So they are starting to do a few because that's the process change which is being engineered within the railways by the current minister. So the capacity to absorb is improving. So remember that moving from they were stuck at 1.5 lakh crores a year, and to moving them to 2.5+ lakh crores a year is a big change. I think there is a lot of action underway which will potentially unlock another 10-11 trillion rupees of projects. But the timing of that, I think there is, of course, the railway bureaucracy, maybe cannot change faster. But you're right that the challenge here is not fiscal capacity of the availability of funds. It is more the availability of the ability of the railways to absorb and execute on some of these projects.
Sure. Now, how do you see the complexion of capex change from here on? And from an investor perspective again, what pockets do you think will sustain growth?
So clearly, see, the announcements on what needs to happen for power capacity have already happened, but I think the investments are only just about starting. Right. So I would expect that things that are more prone to construction, in fact, when you are thinking about the next 3 to 5 years, which is what I think most investment horizons, especially when you're thinking about capex, need to be, you have to be slightly prescriptive. And I would say that, building urban infrastructure, and this is again something which is now starting to gather a lot of traction. You must have seen in the budget as well that there was this 1 lakh crore allocated. I mean, 10,000 crores this year, but 1 lakh crore eventually, based on competition from states. And then this was to be at most 25%. So basically up to 4 lakh crores of capex on urban infrastructure that can be triggered if the states compete rightly. So those are the areas, and therefore, when I think about within industrials where to look, it has to be a lot more on the construction side rather than on the manufacturing side, because with all of this uncertainty in the external markets, the excess capacity in China, the likelihood of very large capital intensive projects coming up in India, other than maybe in strategic areas like semiconductors, where anyway there's no industrial stock in India which is very directly exposed. But mostly, if we do get manufacturing, it will be labor intensive manufacturing, and the type of end demand that benefits investment in industrials would be more on the construction side. So construction machinery, cement, and materials like those.
Sure, fair enough. Now, coming to Trump tariffs, how do you interpret the impact of Trump tariff on Indian markets? I mean, there are so many contradictions in this whole theory itself. One is the rise of the dollar is not consistent with what America perhaps hopes to achieve. And for India also, I mean, on one hand, the narrative is that we will gain because of the China plus one strategy. The other theory is that we could be subject to dumping. Third is concerns with respect to inflationary pressures because of our imports. There's so many things. Please interpret this whole thing for us. Net, where will we be?
I wish I knew. So let me tell you the framework through which I'm thinking. Because see, there's so many moving parts and there are so many layers to this that anyone who pretends to understand how this is going to play out is faking it. So the framework is that look, it's not good for anyone. So if anyone is under any illusion that these tariffs somehow help India, I think they're mistaken. Normal wars, while they are very bad for lives and livelihoods in some specific areas, can actually be boost to the economy. The First World War for 3-4 years was a big boost to the US economy. The Second World War also, because most of the damage happened in Europe and they actually benefited. Trade wars are wars where the objective is economic damage. You will see even the US government statement that they are willing to say, they're saying that we are willing to accept some damage. In fact, there are theoreticians who are saying that this is like mutually assured destruction. That so if the Canadians and the Mexicans are willing to act as mad as the US is acting, then perhaps then the US will back off. And so now that it's threatening Europe, so I think the first thing is that this hurts everyone. This is bad for growth. Second, and the channels through which that happens is very involuntary contraction. So because what happens is your prices go up, so demand falls. The tariffs actually start to help the US government's taxes, and so basically just contracts demand. The third is just the uncertainty that if you are setting up a factory anywhere in the world, you would say, let me hold back. And given that just the first salvos have been fired, if anyone is pretending that, look, in the next 2 days, the Canadians and the Mexicans are going to back off and suddenly the tariffs will be withdrawn, I think they are completely mistaken. Because, and remember that if the NAFTA allies, which are the closest allies you can think of, are actually going to retaliate with tariffs, it emboldens everyone else who may be subject to such tariffs in the coming weeks and months to actually react the same way. So if that they can do it, then why can't we? And then if say the bluff is called, then what is the US left with? So frankly, this is I think there's no positive way to spin this. And then if the Chinese respond by letting the RMB weaken, then then there's a whole new layer of uncertainty that gets introduced.
Right. And you think the foreign selling will continue in this environment?
Yes. So the dollar strengthening is not so much because of any expectations on the balance of payment changes. Frankly, I mean, that's too hard to forecast at this stage.
Yeah.
But it's just de-risking that people want to get into safe assets or what was considered to be safe assets 20 years back. So these are muscle memory these are muscle memories of the markets that whenever there's uncertainty, you dump all the speculative
money
crypto.
goes back to the dollar.
Yeah, and then money goes back to the dollar and to gold. I mean, gold is behaving much better, which again shows that people are really becoming risk averse. So that is the strengthening of the dollar, which I think will be temporary. So once some certainty emerges, when people see how this dust may settle, which could take 3 to 6 months, then perhaps this reversal starts as well. Because as you were rightly saying, this is contra to what the US government really wants.
Right. Okay, so what's your final take on Indian markets? I mean, how do you think this will go for 2025?
First thing is headline. I don't think we will go anywhere. Because I do expect that the underlying earnings will keep improving. So the time correction that we've been anticipating, I think it took maybe 8-10 months too early in calling for peak, and the market ran for a lot longer. But now that the potential growth acceleration in India is now behind us, meaning that the markets tend to extrapolate that if you thought you will grow at 5.5, you grow at 7.5, and they keep extending it and P multiples go up. But now that 7.5 is now starting to become 6.5, I think at the P multiple expansion is unlikely. What has also happened is that given the high prices, the supply of equities is very high. So even this year, there's going to be 7.5 lakh crores of supply in terms of promoter selling, IPOs, block trades, etc., etc.
Yeah.
Whereas the demand is only about 6 lakh crores. So on both these fronts, the P multiple doesn't go anywhere. The enhanced global uncertainty means that the P multiples come off even more. Underlying demand, I mean, the earnings growth should be, because demand drivers are largely domestic in India, we should be quite okay within the sector. So within that market. So this is the headline approach. I mean, if something really bad happens in terms of trade war, maybe there is a deeper swoon in the market correction, but that should be bought into. But within sectors, I would say that the channel through which growth can really be boosted is credit. Because as we discussed, there's not much scope for fiscal action. Given still elevated inflation, there's not much scope for interest rates to come down. Whereas there is a lot more scope to get credit growth back closer to where it was before the slowdown started. And so the channel for that would be the financials. And so while there are many other uncertainties, those would be the variables I would look at when I'm trying to create a portfolio.
Does that not postpone the problem in a way? I mean, if you consider the fact that household debt is anyway at an all-time high, you're saying, let's still focus on credit growth. Will that not create problems for the future or additional risks?
I don't think household debt as a percentage of GDP is very high. The debt that you're talking about was the unsecured personal loans, where India really stood out as a percentage of GDP. If you look at mortgages as a percentage of GDP...
I'm just thinking because that's the one which... No, I'm asking you only because that's the one part that can change very quickly, right? Because corporate credit or industrial credit is a bigger ask because companies cannot invest.
Totally agree. In fact, we have written about it. We said that, look, currently investing cash flows for the BSE 200 are only 70% of operating cash flows. So the companies are generating a lot of cash profit.
Right.
They are not deploying much of that. In fact, 2014 it was 140%. So they were taking on debt to fuel capex. Right now they're not doing. Capex is growing, but not growing as fast as operating cash flows. So we have written that FY 27-28 is when corporate credit will start meaningfully picking up. It has to be household credit. And frankly, if you divide household credit into mortgages, auto loans, and other forms of credit, unsecured personal loans, where there was a problem. See, the problem, I think that is narrative has been completely distorted. This is, MFI and unsecured personal loans are less than 10% of system loans. There was a bubble, there was excessive growth there, which has had to be deflated. But in the process, what we ended up doing is bringing down overall credit growth from 17 to 11. So, mortgages to in India are really, really low. I mean, there is a lot of scope. See, otherwise, how do you stimulate demand? Because, if the price to income ratios for real estate are at a reasonable level and they are much below where they were 10 years back, the economy will boost greatly from some support to the real estate construction cycle. And this is a channel
Right.
through which you can actually boost a lot of credit growth, which then creates money supply and a lot of other things start flying. So this is something we have to
Right.
really, we perhaps need to. I'm being a bit prescriptive here, but this is where
Right.
I think policy should focus a lot more.
Sure. That's all we have time for. Neelkanth, thank you so much for joining me this morning.
Thank you, ma'am.
Always enlightening when I speak to you. Thank you so much.
Thank you.
That's all from the studios today. Keep tuned into Money Control for minute-to-minute coverage of markets and more views and opinions and analysis on moneycontrol.com.